from a past discussion, I got the sense that you guys are more conservative than maybe the consensus on this economy. I took the recession talk off the table a year ago.
By March 2025, the U.S. economy will be in a complete recession. Now, analysts rely on treasury rates to forecast downturns, measuring the variance between 10-year and 3-month rates. According to the latest Federal Reserve policy meeting, the crisis in the banking sector could be a key factor leading to the anticipated recession. You see, despite facing higher interest rates last year, our economy flexed its muscles and showed some serious resilience. Can you believe it? According to the latest stats, our GDP grew at a rate of 3.4% in the fourth quarter of 2023, even better than we thought. And get this, for the whole of 2023, the economy grew by a solid 2.5%, beating expectations left and right. But the thing is, can consumers keep splurging enough to keep our economic engine chugging along? Now let's talk Fed, shall we? Since 2022, they've been playing the interest rate game, bumping it up from near zero levels to a whopping 5.25%, 5.50% by July 2023, the highest since the early 2000s. And that's not all. They also hit the brakes on their bond buying spree. But hey, despite the Fed's efforts to cool things down, consumers didn't flinch. They kept on spending like there's no tomorrow, keeping our GDP growth in check. Now here's the thing. The Fed might just switch gears soon, hinting at potential rate cuts down the road. But don't hold your yet. They're in no rush to hit that reverse button. Thanks to the Fed's bold moves, interest rates across the board have been on the rise, from certificates of deposit to mortgage rates and everything in between. Yep, you heard it right. Even your credit card debt and car loans aren't spared from the hike. It's because the real action is in the lending game. With mortgage rates creeping up to nearly 8% in October 2023, the highest in over 2 decades, things were looking dicey for a while. But no worries, homeowners and businesses were one step ahead, locking in those lower rates before the storm hit. Now, on to the million-dollar question, can our economy keep it going? Well, if 2023's GDP reports are any indication, we might just be in luck. The Fed has high hopes, boosting its 2024 GDP growth projection to 2.1% from 1.4%. However, recent data shows a slight dip in consumer spending. The big question now is whether consumers can keep the cash flowing fast enough to keep the economy running. Anyways, with the economy revving up, we might just see some sweet gains in the stock market. Yup, you heard it right. A booming economy usually spells good news for your stock portfolio. But here's the thing. If the economic data takes a hit, don't sweat it. That could actually mean the Fed swoops in with some rate cuts. And guess what? That's like music to investors' ears. Stocks and bonds alike could get a boost from that move. Now let's zoom into the S&P 500s. After taking a bit of a tumble in 2022, it bounced back with a vengeance in 2023, soaring over 26%. Take a good, hard look at your investment portfolio with your financial advisor. Make sure it's up to snuff and ready to ride the waves in this ever-changing economic landscape. Remember, diversification is your best buddy in times like these, so spread those investments far and wide. Keep your eyes peeled. Guys, job data and retail sales will be the telltale signs of where we're headed. And let's not forget about those interest rates. If they keep climbing, it could put a damper on business activity real fast. Anyways, what do you think? Are we anywhere near? Do drop your thoughts in the comments section below, and we'll meet again in the next episode.